what are currently the more most popular options?
One of the things we do when we look at the volumes in the options, we kind of try to understand what are the traders doing out there? What are the investors doing now out there? Where are they concentrating on it?
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. The following podcast contains options-related material. Prior to listening to today's podcast, all listeners should read and familiarize themselves with the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the show's notes or podcast description page. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everyone. Welcome to IBKR Podcasts. I'm your host, Jeff Praissman, Interactive Brokers Senior Trading Education Specialist. It's my pleasure to welcome back the co-founders of Market Chameleon, McBride and Dmitry Pargaminik. Hey, guys. How are you?
Pretty good. How's it going,
Hey, Jeff? Thanks for having us, buddy.
Oh, it's my pleasure. It's great to have both you guys back in the studio. You guys have a long history with Interactive Brokers. I'm excited now that clients can subscribe to Market Chameleon directly through Interactive Brokers.
Yep, that's right. We've started our integration with Interactive Brokers. Part of the first step was to allow Interactive Brokers customers to subscribe directly from Interactive Brokers to Market Chameleon. This way, you don't need a credit card. You get an extra 30 days free trial. It makes it much simpler. It's connected right to your account. And the idea there is that eventually we'll create a way to link your account to Market Chameleon, and then it should be seamless as far as you're seeing your positions and risks within Market Chameleon.
That's going to be great. And today we're going to actually discuss a topic that's near and dear to all of our hearts, trends in option volumes.
Yep.
And so, let's kind of start off and, what are currently the most popular options?
Yeah, and one of the things we do when we look at the volumes in the options, we kind of try to understand what are the traders doing out there? What are the investors doing now out there? Where are they concentrating on it? And of course, some of the most popular options happen to be the most popular stocks you hear in the news, such as Tesla, SPY, QQQ, Meta. All those usually are the top 10 busiest volumes as far as options go, and there's a really big concentration of volume in those top 10. And just to give you an example, there are currently 5,913 equities that have listed options, but the top 10 alone make up 50% of the volume in the options space. So very concentrated on those popular names. And if we go down a little bit further and take the top 100 stocks, then we're talking about 80% of all the options volume.
When you say volume, there's really two types, right? There's the notional, the dollar volume, and then there's also the contract volume. So for example, if a contract's worth 10 cents, you have to buy 10 of them to equal one that's worth $1 to equal the same notional volume. And, in what does each one show? If someone's looking at options, why would they look at notional? Why would they look at contract? Obviously, why would they look at both to sort of get the full picture?
Yeah, there are two different ways people look at the options volume. One is just to take the raw volume, the number of contracts that traded. And of course, within that, you're going to get options that are going to vary in the dollar amount. Some are very low, some could be very high. So the next step is that people look also in comparison to the dollar volume in the trades, and that kind of gives you an indication how much actual flow in dollar value is going into the options market. And that would be the difference, like you explained, where you could have an option that is 10 cents that traded 10 contracts, and then you could have an option that's $100 and traded 10 contracts. but in dollar terms, it's a big difference. And you'll have two types of traders, one that can afford to trade 10 contracts for 10 cents, and another type of trader will not potentially be able to afford to trade 10 contracts, $100 per contract. And that's why we take a look at volume from two perspectives, the total volume and then converting that volume to dollar notional.
So it's really just to make sure that you're looking at apples to apples. In other words, 100 contracts of a $10 option versus 100 contracts of a $100 option contract are very different things.
Exactly, very different things.
And also I'd actually put in too, like I would say another factor would be the trade count, right? Like how does that factor into statistics?
Yeah, and the next thing we break down the volume is the number of trades it took. And you could have volume that is one trade, but 1,000 contracts, or you could have 1,000 contracts and 1,000 different trades. Of course, one trade, 1,000 contracts could be a big institution that traded one time. But if you have lots of different trades, that's an indicator that there could potentially be a lot of interest from different players. And that's kind of the sense you're trying to get. Is it just this one-time big trade, somebody put on a position, a hedge, a speculative position, or are we seeing interest from lots of different traders coming into an option?
And, just to kind of recap right now for the listeners, you guys, when you're looking at the volume, first you're looking at maybe the contract volume and then breaking it down to the dollar notional volume, and then also the trade count. So all these are important statistics that go into you painting a picture of the option trend. But then, of course, as anyone familiar with the options knows, there's also different expirations covering different time frames, and then also other factors as well. So what are some of the telling facts as far as like if you're looking at expirations or trends where you're seeing throughout different expirations?
What we're seeing is that more and more of the volume is gravitating to the shorter term options. Really, when you look at the options that expire within 5 days, they're seeing about 50% of all the options volume. And as you get closer to 0 days to expiration, an option that expires at the end of the day, you even see a bigger concentration of volume within those 5 days. And that is, showing up of traders are looking for options that have a lot of gamma and high theta. And, an option decays. So when an option decays, it doesn't decay linearly. If you have an option with 10 days to go, it's $1. It doesn't decay 10 cents a day. It'll decay slower and as you get closer to expiration, that decay will accelerate. And of course, the last day, the entire thing will decay. So option sellers are looking for options with a high theta that decays really quickly. And then option buyers are looking for options that have a lot of gamma, because as the option gets closer to expiration, the delta, it starts moving almost in lockstep with the stock as it's in the money. Of course, if it goes out of the money, it expires worthless. And that's the trend that we're seeing, that more people are starting to gravitate to the 0 DTE, or options that expire same day.
Just for our listeners that may be a little bit unfamiliar with options in the Greek terms, theta is relating to time decay and gamma is relating to change in delta. So just kind of giving our listeners that may be more new to options a little bit of background.
Right. That's what the trend is. They want options with very high sensitivities to decay, sensitivities to the movement in the stock price.
So then, kind of given that, like, as far as in taking a step back as well, like the fact that they do offer daily options now in several big ETFs and weekly
Right.
options in I don't know how many symbols, but the majority of symbols. I mean, 15 years ago, there were, 12 expirations a year for equity options. And now for some of these ones, there's 252 expirations, I guess you could say.
Right.
So, do you think kind of the chicken before the egg or the egg before the chicken, what has creating these multiple expirations in your opinion, drawn more people into option trading, or have the fact that as more people or option volume increases, exchanges have increased the expirations to kind of cater to and satisfy the crowd of traders?
Yeah, definitely. I think that the exchanges are reacting to the customers' demands, and where they're seeing the demand, they're starting to create products around there. That's why they've been creating more strikes. At one point, we only saw strikes that were $5 apart. Now we have dollar strikes, half-dollar strikes, and now they're creating more shorter dated options. The one thing I think the SIBO is starting to do is expand options trading in the indexes to potentially go 24/7. So in the SPX, we see trading in the options in a pre-market, in the after hours. And one of the reasons you could do it in the indexes is because those options can get hedged with the futures. The stock options, it'll be a little bit harder because they stop trading after 4:30. You do have after hours trading, but they're liquid. But the first step is in the indexes. We do see the CBOE offering extended hours trading in the options. That's the other demand that we're seeing, but definitely the shorter dated options are very popular. And I think that they also became popular as more small retail traders started to trade with Robinhood. They brought in a lot of new retail customers. They created new accounts and got people introduced to options. And we do see that about 20% of the options volume right now are coming from what we would designate as small retail traders, with not a lot of, not a big bank account. I would say maybe they're, smaller bank account, maybe just starting to learn what an option is, not a very sophisticated trade, much more speculative. And we're seeing about 20% of that coming from small retail. But the retail space alone, I think, makes up almost, by our estimate, 50% of the options volume. And that's a lot. It's a lot of retail trades coming into the options market. And that retail looks like they mostly trade in the short-term options.
And I mean, it's interesting that you talk about these smaller retail investors, and judging by the names of the more popular options that you talked about in the beginning of this podcast, they really are all household names.
Right.
There wasn't any company in there or index that most people haven't heard of. You mentioned Tesla and Meta, and these are all Google, these are all companies, Apple, that we regular people use every day, or at least are know
Right.
exist. What are obviously household names seems to be a big part of option
Yes.
volume trends. But what other items can factor into either a spike in volume or a decrease in volume, even if it's only for a single day or a single time period? Like, obviously, you have your popular companies, but there's times where a company that maybe no one's heard of or isn't as popular spikes up there and becomes a top 10 or top 20 option, trend for the day or for the week or for a month or whatever.
Yeah, you will see that certain stocks, they will spike in volume, and it could be based on news that came out recently, and that news can drive traders to come in and use the options to either hedge their positions or use the options to have a certain outlook on a stock. earnings are big, and earnings you usually see volume picking up probably a couple days prior to the earnings event. And there's a certain strategy that people use options for to play earnings. Earnings is a binary event. They come in, they know the event is coming up. So the date is known. It's also known that when a company releases earnings, that is information that's used by the market, and the stock will usually make a big move reflecting, the new news. So people do play earnings using options, and there are different strategies that you could use around earnings, and that's actually very popular around earnings to use options and different strategies. Biotech companies also, when you see something in a biotech PDFA, when they start releasing information or waiting on a ruling, people will go in and use the options to play that volatility. So certain things like that, we do see a pickup in volume, but that volume usually will disappear after the event, and then that volume will drop off, and it's only playing that specific event. From day to day, though, you're right, it's usually the top 10. And what's interesting is that Tesla right now is the number one on our list of the most active options. And if you look down below Tesla, you got SPY. And if we just compare the notional dollar value of the options going into Tesla versus SPY, you got Tesla just today, you could see $1.7 billion worth of options traded. SPY, which represents an ETF of the entire market, the next busiest, is $850 million worth of options traded. A big gap between the 1 and 2. Even going down to the next one, the third one down, QQQ, that's $356 million worth of options. So you could kind of see going from, the number one down the list, it starts to drop off significantly as you're going down the list. Very big concentration of trades in a very few products. That's what so far we see.
Now, is there a way to tell, through statistics? You had mentioned, especially talking about the retail investor, that a lot of it's probably speculative, where they're doing these short-term options. What about obviously options are a powerful tool as well for hedging an existing position. Is there any way to tell from the, strategies being traded, or if, say the overwhelming volumes to puts, that they might be hedging a position, or is it sort of more you sort of have to really just take a lot of data points and make an educated guess at the end of the day about what you think the trend is?
What we see is it would be hard to tell what the actual intent is of every trade, if it's hedging a position or if it's taking a certain outlook in the market. That it would be very difficult to tell because we wouldn't have enough information. One encouraging sign we do see is that there is growth in the multi-leg strategies, and such as call spreads, put spreads, time spreads. That's encouraging because when you start spreading off options, you're also, what you're doing is decreasing some of your risk in the option trade. You're going to spread off some of your delta risk, some of your vega risk, and when you're doing that, it actually decreases your risk. And if you apply it the right way, you could get your probabilities a little bit more favorable than just doing a single leg option. Because when you're doing a single leg option, you're assuming all the risk that one option has: the delta, the vega risk, the theta risk, the gamma risk. But by doing multi-leg trades, you're going to reduce some of that risk and actually improve your odds. And that's what options really, if you take a look at options, advantage of and most powerful thing about options is being able to trade one option against another option, right? That's where you kind of start finding opportunities when you could spread off one option versus another option. That's encouraging, but a lot of people, when they first come in there, they just take strictly a bet, I think, on direction using an option, and they're assuming all that other risk, time risk, vega risk, and so forth. And a lot of times they are using those options inefficiently to try to bet on a certain direction.
So really, when looking at option trends, it's safe to say, as you see multi-leg strategies increase, it's a sign that either more institutional traders are involved in the market, or professionals, or that even retail traders are becoming more sophisticated and more educated as far as trading a strategy that will give them a better probability of a better outcome versus just throwing a dart at the board and saying, I'm going to buy some Tesla calls because I like
That's
the
right.
company. I think the company is going to go up in the next 5 days.
Exactly. That's right. When you start seeing the traders educating themselves more and figuring out how to use spreads, they usually don't go in the other way. They don't go back to single leg options. They'll stick to that and build on top of that, because that is really value that you get from the options and you're not taking advantage of it, and involves a little bit more education. But if they're willing to do the work and they're willing to understand, the different strategies, and you could start out with just a simple spread, right? You don't need to go to 4 legs right away, or 3 legs, or ratio spreads. But we always say, just if you could start out with a single spread, a call spread or a put spread, and learn from there, then you're on your way to, I think, doing much better and becoming more successful than if you just stick to something that's simple. And when something is simple, doesn't necessarily mean, if it's something simple to understand, doesn't mean it's the best thing, right? It's just simple to understand. And a lot of times when people just figure that out, what is a call, they don't want to move to the next step, because even that was hard to understand, right? What is a call option, or what is a put option? They figured it out. They want to stick with that. But really, you got to move your education a little bit further to improve your odds. And we find that those that don't do that usually, don't either see failures pretty quickly, or eventually, they'll start to learn there's a better way to do it.
And,
But that, yeah,
and I'll say, and by definition, really putting on a spread is gonna limit your risk to some, but it's going to
exactly.
offset some risk for you, for the investor,
Yeah,
versus just doing a single leg option.
exactly.
When you continue to look at the
Yeah.
option volume trends, clearly on any given day, we talked about sort of obviously the usual household names, and then the event-driven reason for volume, such as news or earnings. What do you look at as far as knowing, because Tesla could be at the top of the list every day, right? But clearly, today you mentioned it has 170 billion or whatever it was, and tomorrow it could be 3 billion. So what do you look at as far as comparing how even those top 10 or whatever place the option is in compares to what it was in the past, or in the...
Yeah, we try to keep track of the rankings in the volume and the trends, and we see what's climbing. For example, Coinbase right now is climbing, especially with everything going on in the crypto and what's happening with the other crypto exchanges. Coinbase has been climbing in the rankings. Sometimes you see a few stocks that will make the news, and they'll climb and they'll stay there for maybe a week or two, and then you'll start seeing that volume disappearing. But we try to keep track overall what is going up, and why is it going up. If it's going up because of earnings, we've already expected that, and they'll come back down. But what's going up, why would people gravitate to that stock? So like right now with interest rates, we do see that some of these bond ETFs the volumes are ticking up there. People are paying attention, trying to figure out where interest rates may go based on inflation measures, where the Fed may take interest rates going forward. And we're seeing a little bit of uptick in some of the semiconductor space. There are news there, and what's going on in China, what's going on with legislation. We have seen an uptick there. Some of the things when we check, for example, you're asking about hedging. Are people using it to hedge? Are people using the options to speculate? You could also compare the volume from the previous day to the open interest and how much of that volume converts to an increase or decrease in open interest. And what we're seeing is that there's a very high turnover, or I guess how would you say it when there's it's probably a low turnover of volume that actually translates to an increase or decrease in open interest. So there's a lot of volume, but the open interest doesn't always change that much. And what that's telling us is that people, even intraday, are just rotating in and out of positions. And what we see a big SPY trade happening is people start trading at the monies, and as the stock is moving, they'll rotate out of that at the money into the new at the money and so forth. So you see a lot of people either trying to trade the options as a way to collect the premiums, betting that the stock will stay close to that strike. As it moves, we see them rotating to the next strike. But usually, I'll give you an example. I'll take a look at yesterday's SPY, and I'll give you some examples here. We see, I'm picking a strike that's near term, has 2 days to go, and that will cover the Fed meeting today. And we see volume of, like, say, on the 410 call, 23,000 contracts traded, but the open interest only changed by 3,900. It's telling me, that there aren't positions that are getting placed and they're committed to it with a follow through. They're placing those bets and then moving those bets as the stock is moving away, either to another strike or
to another strike or to another expiration.
But the open interest does not grow in proportion to the heavy volume that we're seeing. So only a small percentage of the volume gets converted to increase in open interest, which is indicating that people who are using those options are not committed to holding on to that option.
So I would assume that maybe when people are buying longer term options is more when they're committed to holding on to it because they're not paying the trading fee each time they're rolling it. They're maybe buying a 3-month out option or a leap for the end of the year where they have a long term either thought on hedging. Maybe they have a position they want to hedge one side or the other, or they have a long term belief in the stock and they can get leverage by buying an option position.
Exactly. And that is also one of the differences we see between the smaller retail traders and the larger ones. The larger ones will start going out a little bit further more often than the smaller, even though everybody kind of gravitates to those short-term options. But when you go out to the longer-term options, then that distribution, weighs more heavily on the bigger traders willing to commit to a position. And really, when we look at the very short term, I think that there's a little bit of a disadvantage to retail traders because in the very short term, there are tools out there and services that could give you a slight edge of where the market may be going, and it costs a lot of money to get those services, but you could get plugged into certain news events that are coming out, the limit order book, the order flow, the things that they're seeing in a very short term. There's a bigger advantage to professionals and a disadvantage to the retail customers. But as you go out further in time, that advantage dissipates. It gets smaller and smaller because as you go out further in time, nobody really knows what's going to happen, a month, 2 months, 3 months out from now. It's much harder to price out uncertainty as you go out further in time.
And I want to I kind of want to wrap up the discussion with one last question, and it sort of, I think, circles back on a few of the points that we discussed. How does volume correlate to quote width? And the conclusions I'm drawing just from our discussion, correct me if I'm off base here, but essentially, if something is trading because it's a household name, it's popular, and there's no real news event, but it's like SPY or it's Tesla, I would assume that a higher volume, it's a more liquid option, and the quote width is probably tighter, versus possibly with a news event, or whether it's a earnings release, whether it's a biotech FDA report that's about to come out saying that it's passed phase 4 of the test or it's failed. I would almost think that could inversely affect the quote width and make it wider, because there's so much uncertainty and people are trading these options for very different reasons between household names and event-driven event.
Yeah, definitely. The more volume you see in a stock, the more those bid-ask spreads shrink. And that's because that's part of the price discovery process. As you get more people trading and narrowing the bid-ask spread, and there's a meeting of the minds, it's much easier to kind of price where people think the options should be priced. Of course, some of these stocks that have zero volume in them, there's no price discovery. It's probably a market maker or a specialist. There's one model, that they're running. There's always uncertainty in the model, and you'll see a big bid-ask spread until more people get involved. But definitely, the more volume something has, the more the bid-ask spread starts to shrink. The more the bid-ask spread shrinks, the more people get involved, right? Because people actually scan for that, and some people do not want to trade anything with a big bid-ask spread because the fee to trade is very expensive.
Well, Will and Dmitry, I want to thank you very much for stopping by IBKR Podcasts. A reminder to our listeners that all podcasts can be found on our website under the Education tab, or on Spotify, Apple Music, Amazon Music, Podbean, Google Podcasts, and Audible. Also, Market Chameleon is a frequent contributor at our webinars, and webinars can be found at ibkrwebinars.com. Select our contributors and click on Market Chameleon for all their past webinars. And also, Market Chameleon hosts a daily morning show on YouTube as well.
Thank you, Jeff.
Thank you guys very
Thanks
much.
for everything, Jeff. Great job, D.
Until next time, I'm Jeff Praissman with Interactive Brokers.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at ibkrpodcasts.com. And if you're interested in learning more about Interactive Brokers, visit ibkr.com. We offer more trading education material, such as webinars at ibkrwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the Characteristics and Risks of Standardized Options, or ODD, which may be accessed through the link found in the show's notes or podcast description page. Multiple leg strategies, including spreads, will incur multiple transaction costs. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at IBKR.com. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction. The interviewee's employer or associated organization has a business relationship as a client with Interactive Brokers. Trading on margin is only for sophisticated investors with high risk tolerance. You may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest.